Welcome to Macro Insight. This is my weekly call where I take you through my thoughts on all of the different asset classes out there, which trades I'm looking at, what the main market drivers are and narratives, and how I'm risk managing my positions. If you haven't already signed up to your free 1-week trial, please visit the website link in the description to this video, and that will give you access to the live call with me, and that takes place on Tuesdays at 2 p.m. London time. Hopefully I'll see you there next week. Welcome back everyone to Macro Insight. Today is the 17th of November, and let's take a look at the charts. We had pretty similar news yesterday, obviously on the Moderna vaccine. That was the big one that the market kind of reacted to, basically seeing more rotation like we have been seeing. We'd seen pretty much the previous week on the Monday as well, when Pfizer had its news on the vaccine and the market loved it. So we had a little bit similar price action yesterday, but that was faded fairly quickly. We had a decent move over the weekend anyway, with the markets trading up. Probably the main catalyst there over the weekend was the Asian Free Trade Agreement, which included like 15 nations, China, Japan, Australia included. And that just kind of helped start the week on a more positive footing. So you look at some of the other markets, like Japan was breaking out to the upside, and Chinese markets have been doing pretty well, as have other Asian markets, particularly China internet stocks. They've been killing it, right? So anyway, so we got the Moderna news out. The good thing about their vaccine, obviously, was the idea that the distribution and the transportation was going to be better, because it can be stored at like fridge temperatures. So that's why we got, some of those travel and leisure stocks ripping higher again. But the numbers were a lot smaller. So rather than sort of 30% moves like we had seen the previous week, we were only seeing like 5% moves in the airlines, for example. Right, so let me bring up the charts. Obviously, the tech sector, because of the stay-at-home dynamic, obviously didn't really love that news. I did have a bit of a downtick, but kind of ended fairly unchanged. So you can see the NASDAQ, if I go into the dailies. So on that news, the NASDAQ was relatively benign and hasn't really done too much, right? Since that news came out, it kind of sold off to about 11.5, but it stabilized, drifted back towards 12,000. Whereas if we look at, for example, the S&P, that's been kind of kicking on a little bit. Obviously made that intraday high at 36.70, gave it back. Then we had a closing high sort of on Friday, and we're kind of hanging around there at that 36 level right now. The more exciting chart is if you look at the Russell and what that's done, because obviously that's been the big beneficiary of the vaccine news, taking out obviously those levels pretty dramatically, going from say sort of 1660 to 17 or even 1800 that day intraday, and now kind of starting to get into those high 17s again, right? So, if we go into year end with this kind of vaccine optimism continuing, and the virus doesn't get completely out of control, then who knows where this Russell can go, right? There's definitely some upside left. So on that note, sort of, Biden's basically been saying that, his advisors don't favor a nationwide lockdown in the US. So although we've got local restrictions that are increasing in the US, such as limits to indoor businesses, curfews, things like that, they are more determined by the state governors. And so it's not really nationwide, which is being taken positively. Also, you've got Thanksgiving coming up in the US. So are people actually going to adhere to the rules, right, and follow the rules, even the local lockdown rules, remains to be seen. If they don't, and they just go and meet all their family, etc., around Thanksgiving holidays, you may see an acceleration in December of cases in the US where people just ignored the rules, basically. So there is that potential. So that is one potential wild card, that we could see some big escalation of numbers in the US sometime sort of mid to late December. So kind of watch out for that. What else? Obviously, the virus cases are already exploding quite higher in the US, and the deaths usually lag by about sort of 3 or 4 weeks. 7-day average daily cases above 150,000 in the US. Also, retail sales out today in the US were weaker than expected. So that's giving a sense of like how the pandemic is affecting consumption. In response to that, you've had a bit of Fed speaking going on, saying that, you know, they may kind of need to step up their purchases in their QE program and stuff like that if need be, if the situation gets worse. And so the next Fed meeting in sort of middle of December, if they need to step up their purchases before that, there is speculation from certain analysts that that may be what they do, because it doesn't look like we're going to get a fiscal stimulus agreed now until Biden gets inaugurated. And so waiting around for that, the Fed might need to kind of take up the slack. So sort of watch out for that again as something to hit the tape, and that will generally be probably taken quite positively by the market. So that's kind of what's the main things that are going on in the US at the moment. Europe, I mean, clearly they've been in stricter lockdowns. Austria imposed a super strict lockdown recently. France have been talking about, you know, not lifting the bars and restaurant shutdowns until maybe even mid-January. But then these restrictions do seem to be having an impact on the case counts in Europe, and we're starting to see that curve turning over a little bit in a few places, right? So, you know, that's just the way it is. Market seems to have focused a bit more on the vaccine optimism than the state of the current lockdown in Europe. So, you know, the move in Spain has just been incredible. So you see here, sort of from that low where we were pretty much at the end of October, I mean, that's more than 20% rally basically in Spain, right? So, I mean, financials are a big driver of that move, but in general, you know, Europe's got more cyclical stocks, it's got financials, it's got oils, it's got a lot of these value stocks basically. So that growth to value rotation has been a nice and a favorable thing for Europe basically, right? So if you are of the belief that that is the kind of new trend, and we're going to see more of that positive sort of news flow and that optimism over the next few months as we go into, say, year end and Q1, then maybe Europe is the spot to be, right? Because there's still a lot of underperformance that it's had over time, and there's a lot more catching up it can do if we're going to kind of come out of this thing sooner rather than later, right? So some people will probably be pitching that long Europe, short US trade as a bit of a contrarian trade to play this these vaccines actually coming through and delivering on what the promise is, basically. Okay. Yeah. One last thing to mention in US equities is Tesla. There was news overnight about Tesla being included in the S&P. So Tesla's kind of gapped up sort of 13%. Obviously, there was a lot of retail chasing, you know, before the stock split and all that stuff earlier in the year, because they thought they were going to get into the S&P earlier. They didn't make it. Some of that froth came out. Obviously, you had that big correction in September, and now the market's kind of going to probably start chasing that again, because there's going to be a fair amount of passive inflows coming on the back of that, where people, it'll be in the top 10 of the S&P because of the market cap of Tesla, right? So there will be some decent buying flows that have to be done, and it is a stock that retail love to chase. So I'd watch for that to maybe attack its highs actually over the coming sort of few weeks. If that's, it's going to go in on the 21st of December. So, you know, about a month's time. So that story is probably going to start to gain more and more momentum. Yeah. So that's US equities. What else? So FX wise, you know, let's look at the dollar, DXY, heading back towards the low end of the range, not far off that 92 level. That's the big story, right? Is the dollar going to take out the support to the downside? Because if it does, then it's probably going to drive all risk assets higher. It's going to drive commodities higher. That's the big question. You look at that chart, no real reason to think it's going to stop. So I wouldn't get in the way of it, to be honest. You know, it's had that first bounce when it hit the lower bottom. It's had a couple of bounces off these lower Bollingers. but the way it's trading to me looks quite heavy. So at some point, you know, the test of these support levels, yes, it's held for now, but it feels relatively, to me, it feels quite inevitable that it's going to take these supports out at some stage, right? So I'd watch for that, and I'd watch for an acceleration down. And, you know, the kind of levels we're going to be targeting, if we take our 92, well, it probably goes towards 90 pretty quick. So that's a couple of percent straight away, which obviously going to take the euro up probably towards sort of 121 and 121, 122 sort of levels. And then there should be some more support down here around 88. Now, I'm not saying that necessarily happens before year end. It's very possible it could happen before year end, but that's probably the next big move in our future on the DXY. That's certainly what it looks like to me looking at that chart. If you look at that chart and zoom out, you know, those rallies, you're making lower and lower highs. Those rallies are kind of, you know, petering out quicker and quicker. And that feels to me the way we're going in the DXY. Yeah. If we switch over to the pound, pound's really all about Brexit. You know, they keep having deadlines, they keep missing them, they keep extending it. I mean, there's some talk about a potential deal being done by next week, but then there's also talk about having until literally the end of December to get a deal. So I favour this stuff to keep going on until December sometime. Whether or not we actually get a deal or not, you know, who's to say? But right here, right now, cable to me feels a bit toppy, and the risk reward is definitely skewed to the downside. If a deal doesn't get done, we're going straight down towards 125 or lower, right? So, and if a deal does get done, I don't see us having that much upside past 135 in the pound, right? So that's kind of how the risks are skewed on the pound to me. More interesting is probably gold. Obviously that got whacked last week on that initial Pfizer news. But it's all going to really, the kind of path for gold is going to be all about real yields. Yeah, so we had the move down. We kind of held those lows that we had already reached back in September. We held it on the first test there. I don't think the bounce is overly convincing just yet. And like I say, there's definitely a risk over the next sort of month or two. People get a bit more optimistic on the vaccines working, on the world returning back to normal. There being a bit of a increase in activity, in economic activity, all those things. If real yields go up, gold's going lower, right? Then the question really becomes, where does gold find support again? You know, there's definitely an area of support around this 1830 level, although that's not very far away. If that gets taken out, I'd be looking at 1760, and below that, I'd be looking at around 1700. Yeah. So those are the levels to watch for. I've been long gold for a while. I have definitely put some hedges in place. Let me just have a look. Yeah, so I put some hedges in place for the end of January. So I've got the 1750, 2050 risk reversal, and I'm using that as a way to hedge out some of my longer dated gold pension exposure. Yeah, I don't really feel comfortable being naked long gold when the market is kind of showing me that there's definitely risk of a more meaningful correction in gold, and those real yields have definitely got the potential to back up. Yeah, we could easily see a period, at least of a couple of months, where bonds sell off, gold sells off, and value stocks rally, financials rally, that sort of thing. Yeah, so that's just what I'm kind of watching out for. So that's gold. Interestingly, Bitcoin, not really doing the same thing. So whereas, you know, Bitcoin and gold in theory have had a similar narrative going on that's been driving them, Bitcoin is just completely decoupling from all other risk assets right now. Yeah. So, you know, when gold sold off 4% on that vaccine day last week, I got a bit spooked. I had some calls in Bitcoin, which had made money, and I banked them and I took that money because I thought, well, if gold's going to sell off this dramatically, it's only a matter of time before Bitcoin corrects. I turned out to be completely wrong, and Bitcoin has charged to new highs, taking out 17,000 today. And like I say, it's just completely decoupled, right? So the Bitcoin story is well and truly intact. It's got super momentum. People seem to be loving it. And you know what can happen, right? If we go to a weekly chart, we've seen this story before. And we know what Bitcoin, okay, this graph isn't really helpful, but we know what Bitcoin's capable of, right? So it's very possible Bitcoin can do a move to 20,000 by, you know, maybe year end, I would say. I mean, the rate it's going, I mean, it could do it by month end, which is what, a couple of weeks away. But it's just one of those assets, right? Bitcoin has got its own dynamics, got its own drivers, and that's something you've just got to accept and be aware of, right? So, like I said, I had some calls that were expiring at the end of November. I kind of figured that you know, it made sense to take them off the table, but luckily, you know, I've been accumulating outright Bitcoin exposure anyway for the last 6 months, so fairly happy with that, and doing, you know, not too upset about this rally, basically, right? So, you know, that's the thing. I see owning outright Bitcoin, just Delta, as a call option in itself, basically, right? So to then have calls on top of that is just doubling it up. So I didn't necessarily feel the need for that, especially when it was looking like it might correct. But holding some core exposure, some core allocation of your portfolio in Bitcoin, I've been advocating that for months, and that has not changed. And this price action is only confirming that, basically, right? So yes, we're getting towards the top end of the range. You can see the Bollinger Band, we're there. We've had an incredible run from sort of 12,000 to here without really looking back. Could we have a correction towards 15,000 over a weekend, for example? Easily we could. But, you know, like I say, that shouldn't shake you out of any of your longer term holdings that are, if you're holding those longer term, it's because you think there's realistic odds this thing goes to 100,000 at some point in the future, right? So that's the way to think about Bitcoin. It is asymmetric, risk reward. Yes, we know it can halve very quickly, but we know that longer term, if it stays alive, it can go 100,000. I mean, I think Citibank's technical analyst put out a report recently saying that they thought Bitcoin could go to 300,000 by the end of next year, right? So, I mean, who knows, right? But that's the kind of numbers people are throwing around. So anything's possible. In terms of sectors, sometimes, you know, obviously the airlines have been on fire recently. Don't really need to go more into detail there. Financials are interesting. I have generally been a seller of financials on upticks and stuff like that, but you know, this is potentially a game-changing piece of news that we've seen in the vaccine, and that might accelerate, you know, the move towards some actual growth next year. And if we see that, then we may see yield curve steepening. We may see the long end of the bond market sell off, and that's good for financials, right? So any steepening of the yield curve is good for financials. And financials, if you look, you know, they've broken, you know, recent resistances, and they've got a lot of room to go back to their sort of January, February this year levels. They've got a decent amount of room. This is the XLF ETF. You know, that's about 15% more it could do to just get back to where it was at the start of this year. So there's value, that is one of the value sectors. And, you know, it's something to watch out for. It's going to naturally, if bonds do sell off and that story continues to play out, then yeah, you will see financials catch a pretty aggressive bid, I imagine. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.